I'm very pleased to be here and to have the chance, after a number of months, to publish our action plan on the Capital Markets Union. And I've just come from the college, where there was very strong support for this package, because I think my colleagues all see that the Capital Markets Union is a central part of our overall effort to encourage jobs and growth. And I'm particularly pleased that this is the first of our 3 big single market initiatives set out by President Juncker, on which the Commission is taking action. And it lies right at the heart of our economic agenda, alongside our drive on free trade and our drive on better regulation. Now, I know that sometimes the Capital Markets Union as a concept sounds a bit abstract. Well, actually, it isn't. Because what it is about, at its most simple, is creating the right conditions for more funding to flow from Europe's savers to Europe's businesses. And over the past year, I've had the chance to speak to entrepreneurs from all over Europe, and many of them have said the same thing, that they can't get hold of the funding they need to get going, particularly perhaps if they have a business idea, for example, in the area of biotech, which is sometimes high reward, but high risk to get going. Other businesses can't get hold of the investment that they need to grow. And that is why I think that many European ideas, many European startups are heading offshore to markets where funding is easier to come by and where innovation is better rewarded. I've also had the chance to meet the insurance funds who are responsible for making people's savings grow. They want to be able to invest more in Europe's infrastructure projects. I've talked to the banks who say that they want to be able to lend more to Europe's businesses, and also had the chance to reflect a bit about this huge demographic challenge that Europe faces with our population growing older, where we know that we have to encourage people to plan and save more for their old age. And I think that Capital Markets Union brings these different strands together. So it isn't abstract, it's very practical. It's about unlocking those savings and putting them to work to support growth. A couple of figures, I think, set out the scale of the challenge that we have. Europe's economy is about the same size as America's, but our equity markets are less than half their size. In the US, SMEs get about 5 times as much funding from the capital markets or non-bank financing as they do here in the EU. And if our venture capital markets were as well developed as they are in the US, companies could have raised an extra 90 billion euros over the past 5 years. And perhaps even more importantly, the differences that there are between European member states are greater than the differences between the EU and the US. So I think that if we can build stronger, more sustainable capital markets and remove these barriers to cross-border investment, that there would be very clear benefits.
Hello, Catherine Feore, EU reporter. To me, there seems to securitisation, there appears to be 2 pillars. There is the pillar that you're trying to strengthen, safe, transparent, standardised products, but there's a pillar that you're trying to weaken, that is a capital requirement. Isn't this damaging the financial resilience that you wish to create? The second question I have is, you've cited the Bank of England already. Andy Haldane, the Bank of England, has been quite critical of the impact of shareholders and companies, maybe not in the immediate investment, but the longer-term investment. Isn't the European approach slightly better, where we're not totally reliant on the capital markets, and we take a longer-term approach? Thank you.
I think on the second question, I think what we're trying to do is not, it's not black and white. I'm not trying, and it's a version of the earlier question about the American model or the European model. I think what we're seeking to do is to add to what we have in Europe, which is a long tradition of being organised in a particular way, a long tradition of bank financing, so that there are more weapons in the armoury, both to increase funding and also, I think, actually, to spread, to increase financial resilience. And I come back to my earlier point, that if you have all your eggs in one basket and something goes wrong with your banking sector, when you have a big crisis, the knock-on effect to the whole economy is very significant. And I think if you've got something more diversified, actually I think that adds to financial resilience and adds to financial stability, which I take very seriously. And so far as securitisation is concerned, I think the two things, the framework with the criteria, simple, transparent and standardised, and the incentives that go with it, are part of the same package. It's attempting to identify a framework that can give people that greater security. You know more where the risk resides, and therefore you want to encourage that. Well, I think, therefore, to encourage a return to safer, sensible securitisation seems to me to go hand in hand.
Guillaume Prache, Managing Director, Better Finance. Today, Commission Jonathan Hill presented the Commission's European Capital Markets Action Plan. There are many proposals. Does Better Finance welcome this plan?
So Better Finance stands for the European Federation of Investors and Financial Services Users. So basically, it's the federation of national associations of savers, investors, shareholders, fund holders, life insurance policy holders, pension fund participants, etc. So meaning the majority of EU citizens. We do welcome very much the Capital Market Union initiative, because up to now we are talking about a single European market, but there is no such thing as a single market for investment products and investment services. So we really hope this CMU, Capital Market Union initiative, will be a big step towards this unified market, which should benefit retail savers and investors.
What would you say is missing from the current package?
I think what is missing maybe is more ambitious measures for the people, the EU citizens as savers and investors. As I said, we are almost all of us are such savers. You have your retirement account, or you have your bank account, or you have your life insurance policy, etc. Commissioner Hill rightly said that savers and retail investors should be at the heart of the Capital Market Union initiative, because in fact households in Europe are the main source for the long-term financing of the EU economy, whether they invest directly on the capital markets, like buying shares or bonds, or, which is mostly the case, of course, for the majority of us, they buy it indirectly through banks, intermediaries, fund managers, life insurance. The problem is, I think, the CMU should be more ambitious to improve the situation of households as savers and investors. And I could give you some examples. One, for example, if you wish to invest directly into equity markets, stock markets, shares, now it's a very difficult thing to do for ordinary people, because we are being discriminated compared to the professional investors who are technology empowered. We are not. If you want to exercise your voting rights, if you're, I don't know, for example, a British shareholder of Volkswagen, let's say, for example, if you want to vote your shares on Volkswagen, because maybe, especially these days, you have something to say to the management, it's almost impossible, because the intermediary where you have your shares either will tell you, no, I don't have the material. If you want to vote for a UK share, that's fine, but you know, Germany, I don't know. Or they will tell, oh, but I have to order them, it will take a lot of time. Or they will tell, okay, but you have to pay a fee. So in practice, there are big barriers to shareholder engagement in the Union. This, very unfortunately, is not to be found in the Capital Market Union Action Plan released today.
On securitisation, the Commission have put forward a proposal for simple, transparent and standardised products, but with the reduced capital requirements. Is the investor safe?
First, I think it's a good initiative to have standardized securitization with precautions. First, I don't think it's a product for individual investors. It was not in the past. Even if it's standardized, it's what we call asset-backed securities, is really something a bit complex and more for professional investors, institutional investors. What is important, though, to be safe, because that is part of your question, is that banks who package these loans into securities, that's what securitization is about, keep skin in the game, as we say. We saw what mortgages securitization has done in the past in the US. That was a terrible bubble of 2007, 2008. So banks should keep a significant piece of the loans, because then they will follow them more, scrutinize them more adequately.
You've raised concern about the PRIPS regulation concerning information for investors. Would you like to say a little more?
Yes, that is the PRIPS regulation, which stands for Packaged Retail Insurance-Based and Investment Products. Unfortunately, European law is full of such acronyms, meaning retail investment products. Is meaning well. This regulation aims at providing a simple, standardized 2- or 3-pager document in plain English for once, and comparable from one product to the other when you go to your financial intermediary. Most unfortunately, it's meaning well, but for some reason, the regulator has scratched the mandatory disclosure of the past performance of the product, and together with its benchmarks, the benchmark chosen by the provider, so you could know if the person has met his investment objective or not. You could know if the product has lost money or not. Now this has been eliminated, so soon you will no more be able to know that, and they replaced it in favor of so-called what-if scenarios in the future. This will be first very difficult to design, the industry doesn't know how to do it, will be very misleading, even more misleading than past performance, because past performance is real, future performance is whatever you believe in it, and they will be hardly comparable from one product to another. So that's a very concerning situation, and we already asked the Commission to look at this.